Green Dragon, let's go. There's not much need for any more advanced AI chips. To hell with all the Blackwell, we can
Nvidia jialat.
The media feeds you a particular structure or skeleton, and then you put in your own imagination. Why you want to bother holding this rubbish ETF when the ETF never even go anywhere for the last 20, 30 years?
All right, guys, welcome to the Backholder podcast. Today, I'm standing in for Kelvin. Because I have a lot of questions to ask Chiking today when it comes to the Chinese market, right? So I believe Chiking is, of everyone here, he has the most exposure to the Chinese market. And I think we can get some very great insights from him, especially when he's the one being interviewed. So I want to start off today with the recent market crash over the last 24 hours, right? So if we have all seen the markets, we have seen the S&P lose like 800 billion to 1 trillion, but something interesting just happened, right? US stocks going down, but many of the China indexes, some of the ETFs staying steady and even rising. So I want to ask Chiking, why is there such a divergence in China and US stocks today? Isn't America supposed to be exceptional, and isn't China supposed to collapse tomorrow?
Hey, before we begin, right, I want to thank you for extending this invitation. Being invited back onto my own podcast actually is a different feeling. Let's try to preface the context of why like China even rallied in the first place. I think there's a lot of recent interest, right, regarding the whole basket of equities over the last 1 to 2 months. I think on a year-to-date basis, I think they have been one of the best performing asset class like across the globe. Of course, let's preface this. Everything is just personal opinion. I think there are four key pillars, right, in terms of how we look at this rally. Of course, the first one, you have your tech advancement. Second one, the shift in government stance. Third one, I think there's a re-underwriting of the whole political tension. And I think fourth one is generally just corporate improvement. I think firstly, when you look at tech advancement, a lot of people are concerned about whether the numbers coming out from DeepSeek, the data, etc., is it real or not? What's the efficiency? Whether they smuggle chips from Singapore, etc., etc. I think I'm not trying to ascertain whether those are real or fake, because I think we need a lot of technical knowledge, insider know-hows to know or to ascertain that part. But I think the other part that I guess the general investing crowd, what they're surprised is that I think despite all odds, China has probably once again proved what they're good at, which is to copy, to imitate, and to do it at a much lower cost. So that's probably what surprised a lot of people. And I think a second part that people are starting to realize is really the rate of adoption. I think the ability for them to distribute at a very fast pace, and just the entire ecosystem of players just getting on board onto this whole system itself. But I think in China, if they want something to happen tomorrow, and if it's the direction from the top, boom, it's going to happen tomorrow. Like everybody is going to be on board. You see Tencent building it into WeChat, coming out with another app. Alibaba is doing it. Baidu, everybody is jumping on everything. You can say that they're jumping on the hype cycle, yes, but I think we cannot discount the fact that there's a very strong distribution network and the rate of adoption there is pretty quick. And because of this strong rate of adoption, I think the iteration cycle becomes very quick as well. So that's the first part on tech. DeepSeek is just like the poster child, but I think it underscores, or a lot of this discussion don't really take into account that spirit in terms of how many of these innovation or adoption is happening in China today. So that's the first one. Second one, I think shift on government stance. We know that there's this recent symposium, right? Then there's this thing that went viral, I think on Weibo, or is it on WeChat? Jack Ma shaking Xi Jinping's hand. It's a very more of a symbolism thing. Not so much about what is the actionable steps, but really it's just to tell people that, hey, we have make up, probably everything is fine. We are going to support private enterprises again. Thirdly, I think it's really the idea of re-underwriting geopolitical tension. This thing is very interesting because before Trump was elected, there was a lot of people stirring this pot, right? Saying that, oh, Trump 2.0, they're going to kill China, terrorists, whatever. But I think after, at least for the first 2 months, we've seen that actually China is not singled out. Trump is just doing Trump things. He's talking to Canada, he's talking to Mexico, whatever, his interview with his cabinet, and then saying that Xi is his best friend. They don't want to chase China out. They want China to invest in US. Because markets are forward looking, so back then, a lot of people are really trying to project the risk and trying to assess that kind of risk premium. But right now, they are trying to re-underwrite this tension. And because maybe you can say that it's unfairly beaten down. So that's why with this kind of, I wouldn't say easing, but it's more like an expectations reality mismatch. That's why there's some sort of a re-rating of the multiple again. And I think the last part, of course, is in the general investing space. Like a lot of the companies that I've seen over the last 2 years, they've kind of rebounded from the 2023 lows, and they're starting to post revenue growth again. You can see that a lot of their cost discipline, they're doing well. You look at all your banks, like I think Sean is also invested. Chinese banks have been staying steadfast with their dividend policy. Tech companies are doing buybacks. Then those that don't buy back, for example, like Baidu, they have, I mean, I'm just throwing out some names. Please look into the companies before you buy. But Baidu, despite just having a lot of cash on their balance sheet, they're not buying back shares. So actually, the share price didn't react much. But when, on the contrary, if you look at companies that are a lot more so-called shareholder friendly, in a way, they are setting their track record straight out, telling people that, hey, don't worry, I'm giving you special dividends. I'm maintaining my dividend policy. I'm buying back my shares when it's low valuation. It gives some sort of confidence to the investor base that, yes, I think these companies are probably decent. So I think those are just the four main factors that I can think about when I'm trying to assess why there was this rally. Now begs the question again. Why is there this divergence? I think firstly, if I can answer your question, then I wouldn't be here. But I think just to preface, this is my own estimate or guessing, right? Is that there is really this huge divergence from US and ex-US, meaning to say there's a very stretched multiple where a lot of people are saying that all these US exceptionalism. And of course, there's truth to a very large extent to this whole narrative. Why is China not going down in lockstep, right? That one, I really don't know. I was also expecting everybody to come down together. It's just that they come down to a lesser extent. And I think regardless, if you look at it on an absolute basis, China stocks are probably still kind of undervalued if they can recover. I think there's a very big caveat here is that if the recovery growth do get into the real world, meaning to say it gets reflected into growth and earnings, I think they're still all pretty undervalued.
The news that just came out was that Trump is going to hike the tariff on China an additional 10%, right? Would that change the equation or what you just mentioned about the relationship between Xi Jinping and Trump, about all this Chinese economy? Because you whack all this tariff, it will hit Chinese producer as well, right? So would it change your view? And let's say if 10% is not enough, they hike another 10%. If we keep on extrapolate this, will you be concerned? So I want to hear Chee King's view and also Sean's view on this as well.
Maybe I'll start lah. I think just a very important caveat here is that when you ask my view, right, then you have to look at the real view. Because now I'm just trying to explain to you in retrospect. Of course, all this is a bit horseback cannon because things have already happened. But I've personally been positioned in China for quite some time. Not because I think that geopolitical tensions are going to ease or whatnot. My main view is still, I believe it's an ebb and flow. Economy is still going to recover. I like to buy in bear market. I like bear multiples. I don't think that this is the end of the investing space. So I primarily want to focus on companies' earnings growth and their ability to grow free cash flow and making sure that their interest is aligned with shareholders. To a very large extent, if you think about it, a lot of people have been saying that China is uninvestable for the last 2-3 years. But let's not kid ourselves. If the entire Chinese market today is selling at $1, you don't buy? Really? You touch your heart and you ask yourself, the entire Chinese stock market today, if they're selling at $1, you don't buy? I think let's not try to pull this whole discussion to be too far away, saying that, oh, something is uninvestable. I think there is probably a right price. Today, even you ask me if I can buy the whole Russian economy or the Russian stock market for $1, I think people might consider. So back to my point is that my main view is still that I do see some sort of hope in terms of the recovery in earnings. Multiples, we'll talk about it later because I think we have a question on multiples. But if the companies really do trade at a very, very large discount, trading at like 5 times price to cash flow, 5 times PE, means that in 5 years you'll get back, and the company is growing, they taking care of shareholder, they buy back their shares, they give out dividends, then I think it's still some sort of an investable instrument. Like the risk reward makes sense for you to take that to be compensated for the type of risk that you're. Back to Bunti's question about the Trump-Xi relationship, whatever. There's a lot of narrative here, like there's a lot of story building here, right? But I think I just wanted to display or cite some numbers lah. If you think back again in Trump 1.0, it's not the first time that he's doing tariffs. And the fun fact is, when Alibaba or some of these tech names, they are near its peak during Trump's era. Why the Hang Seng or why the China index crash is probably because they started the 3 red line thing and all this tech crackdown. Investors are more concerned about their own home politics rather than what Trump is going to do to the companies. And also there's a very slight nuance here is that you need to look at the companies that what's the main business, or how do they derive revenue? So if they are caught in the crossfire of this tariff war thing, then I think those companies are probably in a more shakier fundamental. But when you look at really pure breed Chinese companies, I'm not too sure how the effect will be when you talk a lot about all this posturing about Xi and Trump. Meaning to say, yes, I do read up more like for knowledge purposes, but I don't really think that, I estimate in my Excel sheet or my DCF model that, today they say X amount of percent of tariff means that I need to hit my bottom line margin by 10 basis point. No, I don't do that kind of analysis.
Yeah, I think I kind of agree with Chikeng as well. He has gone more into the investment side, so I think I can add more value on the macro side. Because if you look at how China's position today over the last 5 to 10 years, they have actually diversified their entire customer base as well. Like if we look at what happened during Trump's first tariff war, which I believe was in 2018, right? I think at that point of time, a huge percentage of Chinese market flow, the product flows, goes into the United States. After Trump came out with his tariffs, China decided to actually build more relations, more markets in emerging economies. So you can see them almost everywhere, right? From Thailand all the way to Latin America. A lot of cars, BYDs, solar panels are all being sent there. They might take a margin hit because of Trump's 10% tariffs in certain industries. The ones that are extremely uncompetitive for China to export to the US, like cars, solar panels. You have like what? 50 to 100% tariff. So obviously for that market, it's going to get isolated away from the US. But then there are other markets out there which you can consider them to be greenfield. There's very little tariffs on China, or maybe non-existent. And there's no other country with such an efficient supply chain that can push down margins and still earn something. So they are in these countries, they're earning more, you can say, in a form of a bulk revenue. Then when we bring the conversation back to the US markets, right? We all know the meme: 70 to 80% of stuff is still made in Walmart, is made in China, right? And US supply chains, they are not able to catch up with their own production to satisfy their own consumption. And when Trump goes on this so-called economic war on the world, this tariff war, what he's trying to do is also push up all the input costs for his industries as well, whether it's aluminum, whether it's steel, the cans made of coke, all those is from aluminum, right? So the cost of production goes up, and if the cost goes up enough, it can actually offset the additional tariffs on China. So from that aspect, I'm not too afraid of it. China can always go out there, they can find new markets. And within the US itself, right, supply chains are so brittle and consumers themselves are so skittish, right? I think, and the gap between prices made in the US and China is so wide, I don't really think a 10% tariff is going to hurt that much.
If I can chime in a little bit in terms of this supply chain discussion, right? I've heard a lot of people talking about concentration risk. Everybody's diversifying. US is no longer buying from China, etc. I think in the very short term, demand will still come from the same place. Supply is still going to come from the same place, unless everybody can create big infrastructure in a short period of time, and then you can hollow out certain industries. So I do believe that a lot of the hollowing out, like let's say the automobile industry from Japan and from US and Europe, right? It has already been in place. Like the tailwind is already there. China is already taking over the automobile sector with BYD and whatnot. But a lot of all these discussions about suddenly Mexico become US's biggest trading partner, I think we see a lot of this headline, right? To me, a lot of these are just Han Ko Hao. Yeah, we are diversifying our supply chain. But you really think about it, Mexico really can come up with all those manufactured goods. We're talking about physical things now. We're not talking about software where they can scale like infinitely with the overnight. That doesn't make sense. So what happened is, if I can share my screen, right? This research is done in 2023. So this is from BIS. They talk about the lengthening of the supply chain, and you can see that for both US and China, the location of their customer. So the red line is the location of the suppliers, and the blue line is the location of customers. So they did a very comparative analysis from 2021 to 2023, and the distance increase. Means, long story short, actually they're just lengthening the supply chain. So it just means that China probably sent to somewhere, then someone sends to Mexico, then Mexico sends to US. And then the product is still created in China, and then it still lands to the biggest consumer space, which is in US. Like if you want to stay intellectually consistent, the demand will probably still come from some of these major players that have the purchasing power, and the supply still comes from some of this manufacturing powerhouse. In the short term, that's what's going to happen. In the long term, however, or medium to long term, I, however, do agree to Sean that I think there is still a lot of green fields and areas to explore. But yeah, I think US will still be the biggest consumer. China will still be the biggest manufacturer.
Okay, I think I want to throw the question to Bunti a bit, right? Especially when it comes to the tech sector, the DeepSeek scare. And, over the last 24 hours, we did see NVIDIA lose a lot of money, a lot of market cap. I'm not so sure how much. I think it's between 300 to 800 billion. So we can kind of see, at least on the investor level, this narrative is working, right? China's DeepSeek is destroying NVIDIA. There's not much need for any more advanced AI chips. To hell with all the Blackwell, we can just operate in a world that's one step lower. And all the Chinese tech companies, they'll come up with less competitive chip, but it'll be 5 to 10 times cheaper. So Bunti, what do you think about this? Is it the end for NVIDIA or the US AI hype train, or do you see a different trajectory?
Wah, NVIDIA jialat. No lah. Actually, NVIDIA, if we just focus on their Chinese market, right, where they ship all this, what they call the H20, which is a chip that is already, less good as compared to those that sold to US customers. Yes, DeepSeek came out. People say that, oh, you don't need all those expensive GPUs. But actually, what happened after DeepSeek is that there are many startups in China that just rush in to do something similar to DeepSeek, because DeepSeek is open source, right? So I believe most of them, they can just take the open source and then build on top of that. And instead of like just concentrate to just DeepSeek one company, now it actually broadened up to quite a number of startups that wanting to have all these GPU chips. But the key point is that they are still looking for NVIDIA chips rather than some other alternatives. So I do think that for Chinese market, it's quite healthy to look at this broadening trend, but we are just one executive order away from, okay, these things also need to be banned. So then it will be gone, the entire market. I do think that even NVIDIA themselves also recognize that this risk will always be there. So hard to do a projection.
To put it bluntly, NVIDIA can buy, Isai Boibo.
Can, always can. You look at their valuations also getting a lot more attractive now, given that you look at their revenues keep on going up, earnings going up, and then the price coming down. This is the best thing for investors who are still accumulating.
I see. All right, now back to Chee Keng, right? I think this is where we need to talk about investment multiples, right? For now, everyone knows that the multiples in the US are insanely high. I think S&P is between 24 to 28 P ratios. For the main S&P PE, China is very, very low, right? There's only one market I think is lower than China, and that's Brazil. But then when it comes to China, we have seen a lot of executive orders come out from the US side. Most recently is one talking about investment ban, how Trump doesn't want US companies, US capitals to move their money and invest into all these Chinese names, because there's always a friction of competition. So going down the road, right, we could actually see an environment where Trump might tell retail investors, whether that be pension funds, whether that be even the upcoming US sovereign wealth fund, or maybe that is just retail investors in the US, not to put their money into Chinese stocks. So do you see this actually affecting the multiples in the Chinese equity market? Will it be in such a situation where Chinese multiples will forever be low because of the refusal of American money? Green Dragon, let's go.
To answer your question, right, I think multiple is a very big concern. For I believe it was from Eugene Ng. He talks about the perspective of short term, medium term, long term. I think the idea of multiple really only concerns short to medium term investors, not too much long term investors, because all you are trying to chase is for that re-rating from 10x to 15x. I think when you focus on like really long term, I think generally most investors agree that they all look at company fundamentals, which is the internal rate of return they can compound, the investment projects they can take, the type of growth that you can see, and the earnings per share growth in the very distant future. And when we talk about distant, I think we're talking at least a time frame of 8 to 10 years. And as we know, the rule of 72, if you can grow earnings by 12-15%, you can double every, I think, 4 or 5 years if you divide by 12, 15. So back to your question again, I do agree that because of the whole scare, I think the executive order I did read that order because somebody sent it to me. But it's not necessarily legal per se. Now it's just a guidance, like it's a note to the public. They can't enforce it in a particular way. So you have the external part, and then of course the internal part, which is being unfriendly to shareholder, unfriendly to business people, which was largely created in the past 4 to 5 years, which we've seen in the bear market as well. I think like the media feeds you a particular structure or skeleton, and then you put in your own imagination, and then you think about a lot about all these kind of things, right? But let me just outline something that actually did happen. So 3 mainland companies actually was delisted from the New York Stock Exchange in 2021. They are China Telecom Corp, China Mobile, and China Unicom. China Mobile listed back into the Chinese market, and since 2022, from $57, they're currently at 107. So they went 85% in 3 years. Next up, I think China Telecom also went to the Chinese market. Once they listed in 2021 after the delisting, they tanked quite a bit, but soon after they recovered, and now they're up roughly 30% in a 3-year time frame. So that's the things they are talking about in terms of the listing, delisting, what's the tension and whatnot. It's not like it didn't happen before. Similar to Trump, the tariff, it did happen, and the equities market was kind of at their all-time high before the whole crackdown in the property and tech sector. I'm not too sure whether you're coming from the perspective that you're investing into ETFs. Maybe on a general broad-based ETF level, trading multiples actually do matter a large bit. But I think when I look at it from a bottom-up, look at individual companies, if I do think that Tencent, Baba is going to recover their earnings, that they are monopolistic in nature, I don't see why investors won't be interested in some of these tech companies, and they won't be willing to pay up a premium. And one more point that I just remember is that actually, if you really want to focus on multiple re-rating or expansion, right, a large part of that has already been kind of front run already, meaning the market has already expanded very largely in the first 2 months of this year. So if you are coming in trying to catch another 20-30% in terms of that re-rating, I think you have to be prepared that you can't capture that alpha in this case, because people in front already captured most of the alpha. So my approach is more focused on bottom line earnings and company fundamentals. So I hope I kind of answered that question.
So let's come in a perspective of a new investor, right? Let's say I'm Mr. Tan, and half of my life have been investing in either the Singapore or the US market, and I want to dip my toes into the Chinese market, but I'm a bit unsure. So in your perspective, right, what are the areas that you believe, the sectors or the stocks that will grow in China over the next 5 to 10 years, and which are the sectors that maybe I want to stay out, whether the sector is messy, whether the internal Hunger Games is still going on, or whether these sectors are going to face a lot of pressure from Trump presidency. What is a good way for newbie to look at China today?
If you're unsure, then stay out. That's really that's right, my real advice. I think don't bother. There are a lot of markets out there that are probably better, but you really need to be comfortable in terms of your understanding and just the amount of volatility that comes alongside it. Because if you haven't started in it before and you were not comfortable or not ready to take a position when it was down, then I don't think you should be chasing it when it's up. I think it's very different compared to the US, that everybody really, the traditional advice is just ask you to close eyes and buy the S&P, and 20 years later you'll do fine. I'm not too sure whether the same advice can be placed in this market that you're talking about. Yeah, but generally, if people that are already interested, so for example, let's take Punti for example, he already has positions in China equities, albeit not a large part, but he was still comfortable with all the risks associated. You can talk about regulations, VIE structure, tense competition, companies that might not deliver the great amount of multiple they are talking about. Once you're comfortable with all these and you're still inside, like even during the bear market, then I think we can talk. But if Mr. Tan now is, he see his friend making 60% year to date after 2 months because China re-rate, I think don't bother.
I'll come to Mr. Tan later, but actually I want to ask Chee Keng, right? Because usually I'm looking at this chart from Yardeni that shows MSCI China. MSCI China, I think they cover even stocks that are not listed in China, say for example, all these Tencent, Alibaba, Meituan, they are all in, including those listed in Hong Kong one. So if you look at their valuation multiple, right, and specifically now we are looking at the forward earnings. So if you look at this red line, this is the price index, right? Then if you look at the blue line, this is indicating where it is traded at. If I just looking at this chart, it's actually still close to 10x PE. So even though 10x PE is like went up from previous level, which is even lower, already went up, bump up a bit, but it is still not expensive, right? You can say the expensive is, let's say, between 15 and 20x. So there's still at least another 30 to 50% to make it bump it up to reasonable or average level, right? So I don't know, when Chee Keng, you said it is not cheap anymore. Are we looking at the same thing?
Yeah, we are looking at the same thing. But before that, sorry if I want to correct my eyesight, right? Actually, it's not at 10x. I think it's closer to like 12x already. You look at the red line, I think it's already moved past the most latest red line valuation multiple.
Okay.
Yeah,
so
it
yeah,
already went up
it's
to-
around 12 already.
Yeah,
You're
it's
saying.
already 12.
Okay.
So maximum we are looking at. Okay, so please keep the chart here. I think this is good. We are looking at the same chart to ease your concern. I think first things first is when you look at this is the 25-year chart. There are only a few times when you don't look at those very high, big movements up and down. But generally, they are trading near 10x multiple. To be very frank, if you look at the pattern here. In fact, yes, there will be a few times that they are trading above 15x, but that's not the so-called normal. So actually, the median multiple here, if you want to take, is between 12 to 15x. So that's why I say the easy re-rating has already passed. Of course, I won't discount the fact that it can go to 15, 20x because it has in the past. In fact, they've even breached the 20x before. But I'm just saying that in general, you can't apply like, oh, S&P, I don't know what's the number, but probably if I remember correctly, their PE median is around 18 times, 20 times in recent times. But you cannot apply saying that because China have all these tech companies, they are maybe even as good in your own world, you think that they're as good, then that's why they deserve 18 times as well, or at least on a broad market index level. So that's why I say, in my personal opinion, I think that at least at 15x is probably okay, meaning it's the already on the higher side. So that's why I say maximum you only can squeeze out another 20% in terms of premium, like just on this re-rating, if you don't look at earnings multiple expansion.
Okay.
Yeah, and also one more thing to take note is that a lot of all these like story that they talk about, which is why I outlined the first 4 factors, right? Let's also not forget that China is still kind of in a deflation environment. We are not too sure what's going to happen in the next 2 sessions that's going to come out next week. What kind of stimulus measures, consumption recovery, property holding of the valuation so that you get a wealth effect, spending coming back in again. All these are still very big question marks. So those things are something that I'm more concerned about in terms of how they translate to earnings for the companies, rather than we go and precisely measure out 12 to 15x, how many percent increase. I'm going to fight back for that 20% premium. I think that's not where I put a lot of my time at. Yeah.
Okay. Thanks for that. I'll come back to Mr. Tan. Actually, we don't have to call Mr. Tan, right? We do have Mr. Eric Kwah here with us, right? So I think Eric haven't been having sizable allocation in China. Actually, none, right? Can I say none? Maybe I can say you still have some C Limited, which I don't know. Can you call it like 30% Chinese company?
That is not China. They have no China exposure. It's Southeast Asia.
Yeah, but the management team is have some Chinese culture and characteristics there. So okay, questions for Eric is that this year, right, we are in Green Dragon year. Why are you still not putting your money in Chinese market? What concerns do you have? We have Chee Keng and Sean here that will address your concern.
I think it's not just China. I haven't really been buying any stocks. Like I bought a bit of Nvidia recently because I see Bunti so hot. So I also want to hot. Then I buy it, then it start dropping. So I guess I better not touch China because I could jinx it, Not really investing in like most stocks. It's just my wife is doing the investing now. Seems like she's taking over because I'm holding my Tesla. I'm like, I'm so sick of the roller coaster.
For Eric, it's happy wife, happy life.
So very happy to listen to what Chee Keng has to say for China.
Yeah, but quick question for Bunti. like after we have gone through this conversation, will you be allocating more into China going forward? Maybe reduce some of your US exposure. Like what if the American exceptionalism, the bubble actually does burst? Is now, do you believe, a time that you want to allocate more to China?
Actually, if I just ask myself, like, what's my interest, right? Like the type of companies that I follow, right? I would say I'll still focus a lot of my time reading about the top holdings in my portfolio. Say, for example, Nvidia, Apple, Microsoft, Amazon, all these companies, rather than even the in US, even the smaller one. Even inside my holdings, also I didn't spend too much time on it. Say, for example, I think I have Snowflake and Salesforce. When they release earnings, I also didn't pay too much attention. So first thing is like very small allocations. The other thing is that just don't have time and not really passionate about it. So for Chinese, right, for Chinese stocks, right, I would say they fall into a category that I would say, yes, valuation wise, I agree with Chikeng. I still want to have some exposure. But in terms of individual companies, I don't have that much of interest. So even if I'm to increase my allocation, it will be just ETF. So that's my plan. But if you ask me whether I will increase significantly, the answer is no. So it will stay at about current valuations. But if it really ran up by 50% or 100%, then you will see the allocation will increase in my portfolio. And that's the thing about portfolio diversifications, right? You don't have to do a lot. Your portfolio will adjust for you. If China market is really 10x better 10 years from now, then my size, my allocation also become, like 10x bigger. So that's the magic of letting the portfolio just run.
Boon Tea is not like the same layman investor. He don't have FOMO one. I've made a China ETF video quite some months back, and I've gotten quite a few comments, and I just wanted to ask Boon Tea's thoughts about it, right? Because I personally, I don't own China ETF. I'm purely stock picking. I only own US or world related ETFs. And the natural question is then, when you pull out the chart of, let's say, MSCI China, Hang Seng Index, whatever, like those that tracks the large A50, whatever it is, they've been abysmal. Probably sideways, if not down, for after 10, 15 years, whatever it is, because of a lot of restructuring. And you can probably argue that the market is not matured. The mechanism, although a bit similar to the US S&P 500, where they pick like top 50, top 200, whatever stocks in the market. But when you look at all these ETFs, they haven't been performing. So I cannot understand what's your logical answer to yourself. Why you want to bother holding this rubbish ETF when the ETF never even go anywhere for the last 20, 30 years. At least S&P, right, when they went through the lost decade in 2013, you can pull out 50, 80 years ago and then say that it still goes up. But this China ETF, really you pull, right? No matter how far you pull, right? Nothing. It shows nothing. So why are you still holding this ETF, can I ask?
I think this question is not about ETF itself. It's not about the instrument itself. Because when you buy ETF, you're still exposed to diversified portfolios, right? Like all the companies within that index. You have all of them. Let's say MSCI China means that you have most of all these big cap, medium cap. They're all inside there. So your comment is not about the ETF things. Your comment is more about just you can replace the word ETF with why you bother with Chinese stock market as a whole. So it's the same question. So it's not about the ETF instrument itself. But come back to your question, right? It's true that Chinese stock market, they don't have as long history as US. US one is really you can have 100 years of historical data to look at. But for Chinese market, it is a lot shorter. And even for the index that you can observe on, let's say, your chart, you saw that there's some number in the early years, right? Let's say, I don't know, maybe 20 plus years ago. But during those periods, actually, Chinese market is still haven't really opened up. Their economy also, the capitalism side also, everything haven't really opened up. So the index is not a good representative of the performance. It's just very inefficient. There's not much private activity, private enterprise. It's only recent, let's say 10 plus years that we start to see there are companies that is actually making some progress. I think Tencent could be one example. We can track Tencent, let's say over the past 20 years, how much gains they have made, right? So all this is a good example, but they just don't have the track record now. So it depends on belief. And some people will say that, because it is 20 years, it's not proven, let's not get into it. I think that's fine if you are not comfortable with markets where the governance structure, the government everything's about China is different from the Western market, right? If you're not comfortable, you shouldn't be in. But if you know the details, the inside out, you can see that the stuff that Chinese enterprise did, right, which is still very similar to US market, then you can see the merits of having some allocations to these companies now.
People will say that you are pulling out, like, again, some extreme example to prove your case. But don't worry, I'm in the same camp as you. I do concur to a lot of your thoughts, but I think more so, it's really more of a blind faith now. As the market matures, as both the ETF market and the financial market matures, there is better price discovery. There's better so-called mechanism to acknowledge the sort of value to build wealth as well in the market. But if not, a lot of the application here is XXX with Chinese characteristics. I think this has been the very famous way of explanation for the last 5 to 10 years. But yeah, that's the general takeaway. Sorry, back to Sean.
As you know, I do hold some Chinese banks, and over the last 6 months to 1 year, we have saw this incredible ramp up in earnings and not earnings, multiples as well as gains, right? I think some Chinese banks, they are like 60 to 70% up if you bought at a low point. So I want to understand your outlook. What do you see going forward in the next few years, right? Because obviously in China, there's a very big incentive for the government to keep interest rates low, and we can see bond yields also low. Does that mean that the cash, the earnings, the NIM for the net interest margin for all these Chinese banks, will they be under incredible pressure? So going forward, we can expect lower dividend yield from them. Their earnings are going to collapse. Their earnings going to crash, and that will bring the stock price down as well. How do you see this whole thing playing out?
Right. I think just a disclaimer as well. Also to give you guys context about this, I actually did own Chinese banks for quite some time. I won't say that I catch the bottom, but it was near the bottom. But I've decided to make the decision to actually exit out my position. Let me pull out the data so that I don't misquote myself. I bought banks in November of 2022 and I sold out in July of 2024. Mostly, yeah, like you said, they have all had that incredible run up. I didn't capture the whole run up because I sold out so-called prematurely. But I think the first part when I talked about a lot of all these re-rating, right? When I was buying it, they were trading at 0.3, 0.4 book. DBS, for context, is trading at 2 times book. So in a way, if they can deliver but of course they don't deliver the same ROE as DBS. They were trading at 1/7 the valuation of Singapore banks, at least when I was buying into it. And then they recently ran up quite a bit. I think they re-rated already up. I think they're closer to 0.6, 0.7 now, if I'm not wrong. You can correct me. But I think one level of resilience that the banks have shown is really the ability to pay dividends. So of course, my total returns profile include the 8, 9, 10% that they're given, but there was a 10% tax. It's really a very interesting phenomenon when I look at some of these Chinese banks on how they executed, and given the current macro conditions, there were a lot of so-called executive decisions that came in through the years about one shot just removing mortgage rates. They just adjusted the rates down so that they wanted to so-called boost the consumer spending, giving them more disposable income, which I would think actually a lot of all these in a dovish cycle, general environment is cutting rates. They want to boost spending. They want consumers to feel wealthier. That was also my main reasoning of why I sold out in July of last year. But interestingly enough, they continue running up. And of course, yeah, you can say that in hindsight, I look stupid because I didn't capture the upside. But I'm just not as bullish as before because my valuation cushion is not as huge as before as well. Of course, not forgetting the fact that they're still paying decent dividend yield. At least if I count from my cost perspective, I'm still getting that 8% because they're not decreasing dividends, even in a challenging environment. I've already captured the initial upside that I wanted to capture. How they're gonna run, I didn't really follow much after I sold out. And I'm just not as bullish as previously when we really go into a real daft cycle. Because initially, if you think about it, right, when they started the whole crackdown thing and they are tightening in 2020, 2021, I was thinking still okay, and I was just monitoring, and that's when you see the bank price just keep going down, because people are expressing their view that there might be a lot of bad loans on their books. Maybe companies will start cutting dividends, but they've proven so-called resilience. We have already seen real policy shift and stances that they want to boost not so much banks' earnings. That's the last part of their priority, but really boost individual households' balance sheet and giving them more disposable income. So like what you cited the other time about their net interest margins and whatnot, that's also my primary concern. But clearly the valuation multiple expansion here beats everything else. But to me, it feels more short-term in nature.
Let's go for the trillion yuan question now. The green dragon, let's go question. Do you think China is going to unleash their stimulus? Because right now we have seen what the US is willing to throw on them. You know, the China, they have come out with all the multiple meetings, meeting Jack Ma, meeting all the ministers, everyone. Do you think Xi Jinping, President Xi, is going to unleash the tsunami gates? Is he going to launch massive stimulus to boost up the entire Chinese economy and as a consequence, the equity market as well?
I have a very conservative view on these though, or in a way contrarian view. I think when a lot of the numbers put out by your Goldman Sachs, JP Morgan, I see a lot of these numbers. It's like free one, the money. 4 trillion, 10 trillion, just say only, right? Because they don't have the skin in the game. But I think when you think back again on what happened, the largest stimulus that came in the other time was probably near the 2008 crisis. That was when you see this kind of large form stimulus that came into the market, which also flooded the Chinese equity market. That's why you see some of this graph, right? 2008 or whatever before that, 2010, 110, I mean, boom, the stock price go up and then boom, everybody go back down. And then they have been staying at that level for quite some time. I believe probably policymakers might still have some sort of a in trauma back in their minds because this didn't happen very long ago. How they've been playing their cards in the last 4 years, they have been taking a much more conservative approach. They're not very quick in reacting. A lot of narrative building, a lot of expectations being built in, and that's why it's very short-lived in nature, because the rally is always very macro related. People come in, they push up the price, they see they're not happy, they push down again. I think this time is different. Is a very dangerous phrase to use, but I do believe that due to the slew of actions that is coming out, I think the signaling of the private enterprises meeting, some of this technological advancement, adoption rate, tech earnings, I've been following them very closely. I'm seeing recovery, real recovery, unless of course they cook their books or they cook their numbers. So I don't pay too much attention on their top line, like unemployment rate lah, inflation data lah, because all those can be GDP growth lah. China is a very big state. Let's not forget. Every provinces, every governor will have their own interests. Once the number go up to central government or the Department of Statistics, the numbers probably massage like at least 69 times. So let's not kid ourselves that all these numbers can trust. But when I look at it from my own data points that I want to collect, I do feel a little bit more confident in this rally. Of course, not saying that of course we go straight line up. Now the momentum is definitely a bit high, and investors are getting a little bit like investing high, right? Because they every day see their portfolio printing green candle. That said, I do think we fingers crossed, of course. I do think that the worst is kind of over. We might not revisit those kind of bottom out valuations, but how do we move on from here? I think it's the bigger question that a lot of people are asking. Can buy or not? Also asking the same question, meaning to say you think still can go up or not. We still need to monitor and see. And to not evade your question back again to your trillion yuan question, I don't think they're going to print like 4, 5, 6 trillion and then just flood everybody with money. They are starting to do more targeted approach, doing all the trade-ins for appliances. They want to boost this particular industry, then they'll set some sort of a mechanism to boost the industry. But helicopter money, if that's what you're asking, I doubt so. Meaning just print 2,000 USD in US, right? Then you convert it to renminbi, it's like, I don't know, 10, 15K, like that, just print. I to every household, to their checking account. I don't think that's going to happen.
You wasted. I thought they're going to give out like the Doge stimulus to every Chinese person. Okay, so Bunti, Eric, any closing thoughts? I think for now I'm quite satisfied already. I learned a lot about China from Chee.
First, I have to say thank you so much to Sean coming on to the show, help us open the podcast, help us do the interview, asking so many good questions to Chee. And it has been quite some time since we invited our own podcast member as our own guest. So I think that's quite refreshing. Hope all the audience that watching this like this. And please also follow Sean on his channel. We put the link at the description. Thank you so much. Thank you. Bye-bye.